Good evening and welcome to the first Business 7 program. Business 7, of course, is a publication that comes out every 2 weeks in Republikein, Algemene Zeitung and Namibian Sun, and in it we look in a bit more depth at current economic and financial issues. Now in this week's Business 7, you can read all about the outlook for the economy for 2020. Also, we will bring you an overview of inflation last year, and there are interesting features and also interviews with personalities in Windhoek. In this program, we are going to speak to Rowland Brown. He is the economist at Ceres Capital, and we will also be talking to Ruusa Nandago. She is FNB Namibia's economist, and she's going to talk more about inflation. Stay tuned in. As usual, we have an infographic in Business 7, and in this week's edition, we're looking at annual inflation in Namibia last year, specifically food inflation. And to discuss the issue with us in the studio, we've got Ruusa Nandago. She is the economist at FNB Namibia. Hi, Ruusa, and welcome to the studio.
Hi, thank you very much for having me.
Thank you for your time. Well, if one looks at the figures, then the price monster was rather tame last year. We had an overall annual inflation of 3.7%, which was the lowest since 2015. So it was nice and quiet on the price front. But inflation, I very often find that people are slightly confused about what it actually is. Does an average of 3.4% mean that prices have increased by 3.4%? Because then they'll very quickly come with a backlash. In layman's terms, what does it mean?
Yeah, so inflation is definitely quite a misunderstood concept, even by learned individuals. But what inflation is, well, the formal definition is just a price increase in all goods and services in the economy. That's what inflation is, over a sustained period of time. But what that really means is that we look at the prices of goods and services at a specific time, and then we look at it at a later time, and we compare and we say, did these prices increase or did they decrease? Now that time can be month to month. We can compare January to December. We can compare 2019 to 2018. We can compare it according to the quarters. So that's really what inflation is. It's just increase in price levels over 2 specific periods.
Okay, and of course, with that comes your purchase power, the purchase power of your dollar. So higher inflation obviously means that you could buy less with the dollar in your purse.
Yeah, so inflation is really why money loses value. So I remember my parents when I was younger used to tell me, like, when I was your age, bread used to cost 10 cents. And I'd be like, what? I can't even buy a sweet with 10 cents.
No.
But that's literally what inflation is. Because prices are increasing by a certain level steadily over time, eventually that 10 cent actually means nothing. Because actually the value of our money, or the purchasing power of our money, is what it can buy us at that specific time. So if you have 10 cents in 2010 and bread costs 10 cents, that's great. But if you have 10 cents in 2011 and bread now costs 12 cents, then you can see that purchasing power has been eroded. So inflation really just erodes your value of money over time. And that's why you get these weird stories of bread used to cost 10 cents back in the day.
And we have a very good example of that now in our economy. I mean, a couple of years at independence, it made perfect sense for Namibia to have a 5-cent coin. Now we are taking it out of circulation because nobody wants it. You simply take the coin and you throw it in a little tin in your house and you know, it gathers.
Becoming more of a souvenir item, really.
It does indeed. So that's what the price monster is all about. What is also interesting, of course, with inflation is that we talk about weights. And in Namibia specifically, it's interesting that our weights, the bulk of it goes for housing, etc., etc. Can you break that down in layman's terms for us?
So before I get to weights, I think it's important to just give an overview of how inflation is actually calculated, right? So our statistics agency is the one that calculates inflation and collects all prices. So Of course, it's impossible to observe all prices in the economy
Yes.
because there's so many goods and services and so on. And so what the statistics agency does is they take a basket of goods, which they think is representative of what average households in the economy consume, and they use a survey to come up with that basket of goods. And so what they do is they come up with, okay, people eat mostly mahangu, just an example, mostly mahangu, so we'll put that in the basket. People buy this car, that car, and so they put that all in the basket. And then they track the changes actually of prices of all the items in that basket. So they quite literally have data collectors or field workers that go to retailers, and then they literally track the prices of goods and services, usually during the first 3 weeks of the month. And then that's how they come up with, then they use the very fancy statistics and maths to come up with what they call a consumer price index. So
that's
it's
right.
Literally an aggregate of all the prices in the economy. And then to actually calculate inflation, then they then take the CPI. So let's say the inflation rate for January, they take the CPI January 2020, look at the CPI January 2019, and then they compare it by how much did that grow. And that's the figure you actually see in the media when they release, for example, 2.6% inflation in December, for example. Now the weights, obviously, because some items we spend larger amounts on, right? So if you think of housing compared to shoes. So of course we need to assign certain weights so that the overall figure is not just an average, because then otherwise you have bigger items dragging.
Distorted,
So we assign weights to different items, and then the weights are based on how much of our consumption categorizes that specific item. So if you think about housing, that's our biggest one, it's about 28%. And then it's then followed by food, which is about 16%, transport 14%, alcoholic beverages 12%, and so it goes on. And so you have other items which have smaller weights. So that's what weights really mean. So that's very important. Otherwise, you just kind of rate houses and shoes the same. Doesn't make sense.
Well, maybe that one maybe could do that. I mean, some women I know, present company not necessarily excluded, have a big love for shoes. Yes, and what is interesting about the weights too is that gives you an indication of spending patterns. So that food, extremely important, and that is probably why when you have, say, for instance, very high inflation in cell phones, won't necessarily push up your average inflation, because if food inflation is lower, then it will sort of stabilize there. But the big thing, the thing that really touched the consumers, food. Food inflation in or last year came in at an average of 4.5. So a bit higher than that of the previous year, but still quite manageable. What influenced that?
So it's mainly drought conditions. So as we know, we are in a perennial drought at the moment. And that, so when we look at inflation, we have a demand side, and then we also have a supply side to inflation. So the supply side, if you think, for example, a very basic example is if you're a baker and you're the only one that bakes, there's a shortage of supply of bakers who make cakes. And so you have leeway to increase your prices. And that's how shortages kind of increase the prices. Of course, in a drought, you see that you have shortage in crop production and so on. So you see your cereals and baskets, your fruits and so on. Their prices then increase because of that shortage, and that's what pushes up the inflation. Interestingly, on the meat side of it, during a drought, because farmers are selling their livestock so quickly, it's actually the other way around.
I get that very often. Why does meat inflation look the way it does?
So for meat inflation, it's because farmers, it's not actually a shortage, it's because farmers are selling their animals really quickly because they want to sell them before they die. And so you have actually an oversupply of meat, or an increase in supply of meat. And so you see the opposite, which is a deflation. But of course, overall, the food basket contains many different items, not just meat. And so the other items that are impacted by the drought then end up pushing up that inflation. And of course, we also import items. So inflation is determined, it's determined by demand and supply, but it's also determined by, for example, movements in exchange rate, because we import, and so if there's a movement in exchange rate, that also affects inflation.
I often get people saying, but then why isn't the Bank of Namibia targeting inflation? Well, basically, it can't, because we're importing at least 60% of what we consume from mainly South Africa.
Yeah.
So we import that inflation. Whatever
Yeah.
happens there
Yeah.
virtually happens here
Exactly.
too. Yes. Ruusa, in terms of 2020, what do we expect, and do you foresee any surprises?
Well, I think the surprise would probably come from the exchange rate side. So
Yes.
if the exchange rate had to blow out, then we'd probably see quite a significant increase in inflation. But I think overall, and I think the market consensus is that inflation will remain sort of downbeat, nothing too crazy, nothing too hectic overall. And that's mainly because we expect our property market, of course, to still be sort of in a contractionary environment, and that makes up the biggest weight of our
Yes.
basket. And also because we expect fuel prices to also remain quite stable. It might even decrease. Actually, we haven't increased our fuel prices since June last year. And what's very important to remember about fuel prices is that they're an input to other sectors as well. So it's so it kind of has a knock-on effect on other sectors. So we think those will be the main drivers, and so we think inflation will remain relatively stable. Of course, from the food side, if the drought conditions do persist, it will push up food prices further, but it wouldn't push it up to the extent that it will sort of blow out, because there's still a demand component where people aren't really buying that much, and so that will help to sort of temper. So we expect inflation to remain relatively subdued for the rest of the year.
Well, that's certainly a bit of good news to the Namibian consumer, who is severely stressed at the moment, and is looking forward to, as they say, any little bit helps. Ruusa, thank you very much for joining us in the studio, and we're looking forward to having you back.
Thank you.
With me in the studio today, joining us is Rowland Brown, the economist at Ceres Capital and Ceres Securities, talking about the economy in general and what we can expect in 2020. Rowland, I think in layman's terms, it is probably not overstating the fact if we say that last year was the year out of hell. What happened last year?
Yeah, 2019 was definitely a very difficult year for the country. We don't have the full year's data yet, but the data that we have to date suggests that it's the deepest contraction the country's ever had since independence. And we expect that when we get the full year data, it will look slightly better in terms of the quantum of the contraction. So the first 3 quarters is 2.4%. We expect it'll be around just under 2% contraction, but still the deepest contraction since independence. And it was basically a sort of perfect storm year in many ways. So we have the sort of general overhang of a sort of slow growing economy, a number of policy impediments, a number of issues in our secondary and tertiary sectors. And then added to that, we had a sort of primary sector crisis, if you will, last year as well. So that came in part from output from the mining sector, which was down quite a lot. So diamond mining, particularly one of our biggest single contributors to GDP, down quite aggressively. And then, of course, the drought that we had, which was both, I think, a humanitarian, but also a production sort of crisis. So we had huge scale sell-offs of the national herd. The national herd is heavily depleted now compared to where it was, or where it usually is around this time of year. We estimate that it's about 60% of what it would usually be at this time of year. And that big sell-off of animals, because there was just nothing for them to eat on the farms, has had a very negative impact on our GDP as well. But I mean, we still have issues in the manufacturing side of things. We still have issues on the construction side of things, big issues on the construction side of things. And then in our tertiary industries, where our services are, there are very, very few rays of light at the moment as well. So just all in all, it was a very tough year last year.
Analysts locally expecting, Ceres included, expect a little bit of a better 2020 with positive growth coming out of the recession. Where will that growth come from?
Yeah, so we're always cautious when it comes to this. So growth is it's sort of viewed in a very binary manner, and of course it isn't. So you have growth or you don't, but that's not quite the way to look at it. The big issue that we have at the moment is that the economy, even if it does grow, it will grow by a much lower rate than the population is growing. So for a per capita or per person, the economy is still shrinking. And that's a major worry. But we do expect to see some small positive growth. We don't think it should be celebrated. We suspect that some people will celebrate it, but we don't think it should be celebrated because it is still extremely low growth. When it comes to the source of that growth, it's pretty much a recovery in the primary industries. So it's pretty much a recovery of diamond output. So we're expecting nearly 20% growth in diamond output this year. And this is not taking us to new levels of diamond output. It's just recovery off the lower output that we saw last year. And then our base case for this year is that we will see a little bit of recovery in the agriculture space. Now that's very uncertain at this point in time because we're still sort of in the early phases of our rain season. Or we're slowly moving through it, but we certainly haven't seen the end of it yet. And our base case is that we have average rainfall. Now, we had early rains that were quite good across much of the country, and there's been some rain recently, but we're still well below normal levels of rainfall. So that assumption that we'll see some recovery there is still quite uncertain. The other thing is that there's a huge degree of what economists would call sort of nonlinearity in the forecast, which means that a small change somewhere can have a big impact somewhere else. And our concern, and in our assumptions this year, we're basically assuming that we'll have a fairly linear outcome. So we're not going to see any real abnormalities that are going to cause some peculiar swing. At the same time, because the economy is so fragile at the moment, because we have so few buffers at the moment, that risk of non-linear outcomes is massively increased at the moment.
As you said, very rightly, talking about growth and numbers and positive or negative, it's very theoretical, really. The man in the street wants to know, is his life going to be any better this year than it was last year? The average Namibian in the street, what are his prospects?
So this is a very difficult thing to talk about, I guess, because there's no really nice way to say it. But the growth that we expect to see this year is very statistical growth. So recovery in diamond output doesn't necessarily filter through to the average person. So what it does do is you'll see the vessels operating a bit more. You will see a little bit more revenue for government. But you're not going to see vastly more people employed. You're not going to see household incomes recovering as a result. You're not going to see government being able to spend a lot more on improving people's lives. So from the mineral output side, it doesn't have a very direct effect if we see this slight rebound, particularly in diamonds. We're also expecting a slight rebound in uranium, but similar problem. Yeah. When it comes to the agriculture side, there you can see a big improvement in people's lives if we get some rain, especially after that horrific drought of last year. But when if we're talking about cash incomes to houses, if we're talking about, are people actually going to have more money to spend in the shops? Are people going to be able to, upgrade houses, vehicles, consumer electronics, furniture, clothes, those sorts of things? We don't see much scope for that this year at all. And in fact, we actually think that there's quite substantial risk this year of quite a lot of small business closures, which will mean more people unemployed, mean a further deterioration in household incomes and similar. The two pieces of sort of respite that we see for households this year is that we do expect another interest rate cut. That should be quite soon, that we expect that interest rate cut within the next week or so. And then we also don't expect high inflation. So if you added high inflation to this already pretty morbid picture, it would become quite a disastrous picture. It's not far from disastrous as it is, but it would become even worse. But with that low inflation, at least there isn't that same price pressure on households of prices increasing. And the low inflation is very much driven by major deflation in the property market, particularly in the central areas, which is one of our kind of key themes for this year.
Rowland, staying with the man in the street, the consumer, I know that in your economic outlook, you painted a picture in terms of comparing to previous years the situation. In a nutshell, what is the status of the consumer at the moment?
So if we go back to that GDP per person calculation, the GDP per capita calculation, because the economy has been not growing or growing extremely slowly since 2016, we now have income per person in the country, or GDP per capita in the country, back to 2012 levels. So basically we had a sort of increase and then subsequently a decrease with regards to household or income per capita. So from that perspective, that tells you from a big picture perspective that households are not becoming more wealthy. In fact, over the last few years, they've become less wealthy. But we can take it a lot further than that. I mean, what we've seen when it comes to households generally is that formal sector employment has deteriorated dramatically since 2016, which is exactly what you would expect given the slowdown in the economy. But that's sort of hidden in the statistics by informal and employment particularly. So the question that determines whether you're employed in the statistics in the labor force survey is, have you worked for a cash or in-kind income in the last in the last week for more than an hour? So what that could imply is that if you looked after your brother's kids for a couple of hours in exchange for a meal, you could theoretically be classified as employed by that definition.
Yes.
So the bar that we set for employment is very low. Now, it's important to note that this is not something that's purely determined by Namibia. This is a sort of ILO standard. Yes. But you can just see how huge tracts of the population will be classified as employed even if they don't have formal employment. Yeah.
Yes.
So in 2018, we only had about 300,000 people who were formally employed out of a population of 2.5 million. And there's been quite a dramatic decline in that number since 2016 when the previous labor force survey was done. So we have a huge percent of the population that's dependent on either non-cash or uncertain cash incomes. And obviously a large portion of that group is dependent on subsistence agriculture. So this is where these droughts are just absolutely devastating. Now, but what we've seen as a result of this is that the cash wages being paid to households have deteriorated. At the same time, government's not increasing wages, which is completely the right thing to do. It's not the wrong thing, but it does mean that you see this continued pressure on household incomes. And then also private sector is not really hiring and certainly not pushing through wage adjustments well above inflation. So from a household income perspective, you're seeing a deterioration in inflation-adjusted terms. At the same time, we have extremely high levels of household debt. So our household debt to disposable income ratio is just under 100%. So this means that your average Namibian household has spent next year's income already. And the implication of that is just that a huge amount of that relatively weak income that households do have is going to service debt. And the change in household incomes is negative, not positive.
Rowland, in Cyrus's economic outlook, you refer to the boom years of the consumer, that everybody borrowed money, government was spending like there's no tomorrow. Well, tomorrow is here now. Could this have been foreseen?
This was foreseen. So this is certainly not...
by government, I mean.
So it was foreseen. We foresaw it.
Yes.
We wrote about it at the time. I remember writing in 2013 or 14 about how the interest rate position that we had as a country was not correct, and that was causing these households to become over leveraged. And at a point when interest rates started to go up, we would see households under pressure. The same when it came to government. We wrote in 2013 or 14 a piece for the IPPR called "Maxing Out the Credit Card," where we wrote about how we were using debt to fund non-productive things, and it was going to come back to haunt us in the same way that if you use your credit card to go to the bottle store, it will probably come back to haunt you. And so, yes, it was completely foreseeable. It was foreseen. And I think but all of that is not that important. I think what's important now is that we say, well, how do we ensure that we're listening to people who can look into the future and say that this is what's happening in order to address the problems that we currently face, because we're far from out of the woods yet. So I mentioned, the growth that we expect this year, this low growth we expect this year, that's largely driven by mining output. Well, if we look through to 2024, almost all of the
Yes.
growth that we expect is mining driven. So we expect to see this new vessel from Namdeb coming into production in 2022, which will add growth in 2022 and again in 2023. But as we've discussed, that doesn't mean that household incomes
Exactly.
necessarily improve that dramatically. And so the impact of this is just that if you strip mining out, we're looking at 1%-ish growth for the next 5 years. The population's growing at 1.8% a year, so we are basically expecting to become more poor for the next 5 years. And that has huge socio-political implications as well, because in the next 5 years we're going back to the polls. In this last election, SWAPO lost half of its majority. If the same continues, if things get worse over the next 5 years, then what? So there's certainly these huge socioeconomic and sociopolitical implications to this macroeconomic situation that we're in at the moment. And what I think has become very obvious is that talking about it and hoping that it fixes itself is not working. We actually need some real reform now.
Rowland, you've referred to politics, you've referred to the economy, poverty, etc. Very central in all these issues will be unemployment. Do you have any idea what the stats are looking like at the moment, and what is your expectation?
So as I sort of mentioned, the unemployment that we report is quite misleading in many ways, because you're capturing people that are, let's call them, enormously underemployed. They are many of such people are classified as employed. So the official rate is a third of the population, 33.4% of the population is unemployed. But as I said, it's only 300,000 out of that full population that have formal sector jobs. So that's just 12% of the population, and that's about 30% of the labor force. So the willing and able to work people in the country. So that would mean 70% unemployment if you were just to look at formal employment. So and that's now 2018 figures. Move into 2019, and we have roughly 140,000 people employed in subsistence agriculture, who you could now say were basically unemployed. And that then has another 14% impact on unemployment levels, and so on. So unemployment levels are extremely high. If you look at youth unemployment, it becomes even more terrifying. So between the ages, I believe it's 15 and 24, 60% of those people that are willing and able to work, so you're not counting people that are not looking to work, but 60% of that group is unemployed. And if you go to your normal youth unemployment definition, then you're talking about 46% that's unemployed. So 1 in 2 young people are unemployed.
It's absolutely terrifying.
Yeah, and the critical thing here is that the outlook for employment is not necessarily good. So the question around this is, so how does it work, or do we have a shortage of employees or employers in the country? That's the sort of way to look at it, because the way that one should consider it as an analyst or an economist as well, what is there more, is there a surplus of one or a surplus of the other? And if you have these high levels of unemployment, what it generally tells you is that there's a surplus of employees and a shortage of employers. So the question around employment is, how do we, where is the bottleneck on the employer side? And there, I think that it comes back to something that we've discussed previously, which is, how do we create an investment climate that makes, people create jobs? Exactly. So there's a whole lot of different things to think about here, and I think one almost needs to stratify the different types of employers that you have. So you need to say, okay, well, are we just talking about big multinationals coming in, just creating jobs here? Well, that's certainly one of the things that we should be looking to do, but it's certainly not the only thing we should be looking to do. And I think what's critical, something that I've written about quite a lot, something that I've been quite vocal on, is that we need to make it easier for Namibians to create jobs for themselves and for their communities and for other Namibians. And I mean, I'm not a great nationalist. I believe, in people, not nations and things like this, but I think that one should really be trying to focus on the communities around you that need support. And the best way to improve people's lives consistently is with employment. Being dependent on handouts from the state or handouts from your family or handouts from your community is not ideal. Ideally, what you want to do is to be employed in some kind of industrious pursuit that is going to result in a consistent income and is going to improve your life as a result of that. And we always talk about this even with households where there is one employed person. Will it be easier to double that household's income by doubling that single person's salary or by adding another salary to the mix? So the impact of employment on improving people's lives is dramatic. If you're employed, you don't have to wait for government to deliver you a toilet. You don't have to wait for government to deliver you a house and so on. You have far more agency to be able to address your own developmental needs and desires and so on yourself than you otherwise would. So this is why employment is so important. But then the question is, so how do we create it? And I think that's where, this thing of what are the bottlenecks to creating jobs in the country? What's the bottleneck to Namibians starting businesses to create jobs in the country? Now, I have a bit of experience in this because I started a business not that long ago. And so I know from first-hand experience what some of these challenges are. Of course, when I talk about these challenges, I'm told that I'm just trying to protect my own interests, which is completely not the case, but anyway, I take the criticism. But the challenges around creating jobs here are largely bureaucratic. So these are man-made challenges. These aren't some sort of, divine intervention. So these are man-made challenges, which is both good and bad. On the good, on the bad, it's something that we are doing that's causing the problem. But on the good, it means that there's things that we can do to resolve the problem. And I think that that's where a lot of our focus has been. Now, many of these bureaucratic challenges are somewhat complicated to address. They require, a change of mentality and behavior, say, from the public service. They require a complete sort of change of processes and how we register businesses. It requires very difficult things to do, like changes to the labor legislation, making it easier to import high-level skills if you can't source them locally, these sorts of things. And those are all sort of technically a bit complicated to do. But one of the biggest challenges that we face is the cash flow pressure that the tax system as we have it puts on small businesses. So cash flow is what kills businesses. You can have a profitable business, but if you've got 6 months where your invoices aren't being paid or cash is taken out of your business and you can't pay salaries, you go under. So that cash flow pressure from the current tax regime is a huge problem. And so we have been promoting a whole lot of things to say, can we not look at how we can reduce cash flow pressure from VAT? Can we not look at how we can reduce cash flow pressure from company tax? Not that we don't want to pay these taxes. In fact, for my business, it's actually not even a problem. I now have changed my thinking to say, let's anything smaller than my business, just so that we can get rid of this idea that I'm just trying to push my own interest. But for those smaller businesses, can we not alleviate that cash flow? Not that you don't pay tax, but that you pay tax when the cash is actually there or when you're turning the capital in your business into income for individuals. So a business it doesn't really exist, right? A business is a figment of people's imagination. We all agree this is a business, but there isn't actually a physical thing necessarily. There's a collection of things within a theoretical structure. Taxing that entity that's creating the jobs, that's paying people's salaries, that's growing the economy, that's contributing to exports and so on. That is a very inefficient and suboptimal thing to do. If you tax when that entity changes what's happening, so it changes the cash or the income that it has into income for individuals, then you can basically address that cash flow issue within the business. Now, if the business isn't paying money out, then chances are either it's not making a huge amount, or it's using that money to grow, to create more jobs, to export more goods, to improve people's lives one way or another. And that seems eminently desirable. And so that's been the sort of angle that we're pushing. However, what we see has been huge resistance to this. It's sort of almost sort of a sacrilegious idea that you should try and promote. Business success. And we take this, I'll finish my long statement now with this very simple thing where we say one of the critical things for an economy is profit. And we have a mentality around profit that profit is bad. But without profit, you don't have businesses. If a business doesn't make profit for a period of time, it sends its staff home, it closes its doors, and there's no employment. Without that employment, you don't have household incomes. Without those household incomes and without that business making money, you don't have revenue for government. So without revenue for government, you don't have government. And it all sort of boils out from there. But this profit is such a fundamental thing, and we should be trying to protect profit for businesses, not excess profit, not profit at the expense of the environment, at the expense of people, these sorts of things. But we should really be saying, what can we do to try and ensure that our businesses stay profitable, that our businesses can survive, that they can keep creating employment and so on. And I think many of these interventions that we have, much of the bureaucracy that we have, has a very direct impact on businesses' ability to generate profit, and as a result, create employment, pay tax to government, etc.
Fascinating insights as always. Thank you, Rowland, for your time, and we'll definitely invite you back.
Thank you very much.
Thank you for joining us. We hope you found this program insightful, and we will be seeing you in 2 weeks' time, Wednesday night, the same time, here on Facebook.